course, we have the December WPI inflation as well at 4.95%, which is lower than CNBC TV18 poll.
Much lower than what we were anticipating. We were working with around 5.4 to 5.5%, and that's coming at a sub 5% figure for the month of December. So that's actually a huge softening which has come in for the WPI inflation. It's definitely at a multi-month low, which has come through for WPI. And to put it into perspective, the CPI data for the month of December was any which way at a 12-month low. It had reduced because of the food inflation, which had seen softness on account of vegetables. But this December WPI inflation is definitely a big positive surprise, which has come in sub 5%. In fact, we do have Lata with us to take us through the reading. Lata, you know, this is actually coming at a big surprise. You know, the upper end was anywhere between 5.4 to 5.5% this time.
No, it's a very, very big surprise. As it is, WPI was headed lower because we are now getting the impact of the large base of last year. That will be even more in Feb and March when you start having the war impact, the Ukraine war impact, the year-ago impact. So this at 4.95 is a very, very big surprise. And I'll tell you, the big surprise is coming actually from primary articles and food. Food is actually 1.25% lower than year ago. It's a minus. I mean, we've not seen that in a very, very long time. The FAO, Food and Agricultural Index, which measures food prices globally, was surging even before the Ukraine war last year. That's why we have a big base impact. But no one expected the food index to go into contraction terrain. Minus 1.25 year-ago levels, from year-ago levels. And when you look at the significant contributors, it is veggie index. The veggie index is down 36% year on year. And within vegetables, it's onions that are down about 26% year on year levels. And the other big contribution comes from oil seeds and edible oils. That one, oil seeds comes under primary articles. Oil comes under manufactured products only in the WPI index. So oil seeds is down minus 5% in year-on-year terms. And then you have other things like minerals also, which have gone down. Fuel and power also is a minus in year-on-year terms when you look at petrol. The petrol price down, I mean, you're looking at wholesale prices, okay? So that one is, 1 minute, down 14.7% in year-on-year terms. Wait 1 minute, I think it's LPG. That's down 14%. When you come to manufactured products, again, the rise is only 3.37%. Year-on-year terms, and manufactured food products, especially vegetable oils, as I told you, oil seeds, is down 6%, a minus 6% in year-on-year terms. All that has contributed to the fall. Likewise, textiles. See, we are talking wholesale. We are not talking CPI over here. Textile wholesale products also is down about 0.5% in year-on-year terms. And as you go down the line, whether you look at basic metals, minerals, all of them, the increase is barely 0.7, 1%. It's a fairly substantial fall because we are talking wholesale and we are talking year on year. And we are seeing a substantial fall in global inflation prices as well. So manufactured products as a whole up only 3.3% from year-ago levels. Last month, that is for the month of December, it was 10.7%. So look at the extent to which the year-on-year WPI fall is showing up in the price. We have
how much of that do you think would be on account of a high base, and how much of that would be actual correction in prices?
Both, no. I mean, we all know that steel prices, etc., have fallen in year-on-year terms, and wholesale has itself shown a substantial fall. It will slowly get reflected in consumer. That's exactly what I would be asking the Economist. Rupa again, it's really the Economist at L&T Finance. Okay, she will be with us in just a bit.
But Lata, just a quick question and add on. You know, now that it's come to a sub 5% figure, it's a 22-month low. The CPI is at a 12-month low. In combination, what does that do when the RBI meets in Feb? And what might the trajectory be going forward, not just the Feb meeting?
Well, to be sure that in the Feb meeting, now the chances of a pause go up. Already when the CPI numbers came in, remember, Ekta, it was a tad below your poll. Your poll was 6.84 and 5.84 and it came in at 5.72. Yeah. So already that was below expectation. Now with WPI also coming in below expectation, below street estimates, chances of a pause, over there I got a 2:3. 3 still thinking that there is a hike in February and then it's one and done. But with the two of them saying no, they will pause in February because the chances of inflation, undershooting 5% in the first quarter of next year, that is April, May, June, now become very, very stark, and therefore there is no need for the Reserve Bank to go ahead and hike in Feb. They can wait in case global inflation picks up, and that's a possibility. After all, we know now that iron ore prices, coal prices, steel prices have all started inching up again with China returning to the market, or the expectation of China returning to the market. So we must be prepared for it.
So begins actually another question with regards to the RBI rate trajectory itself. You're talking about domestic inflation, you're talking about what the global central banks do, and there is no word coming in despite US inflation steadying a little, or the increase in inflation stemming a little bit. There's no word coming in from the US Fed officials that they're willing to pause at any time in the near future. So in light of that, will RBI actually be able to pause, or maybe they may take a hike given what's happening in the global
The RBI's hike from the word go, I mean, if you take, it was 4% repo rate. It today stands at 6.25.
Yeah.
225 basis. How much has the Fed increased in the same time? 475 basis points. So, the Reserve Bank has been moving at a very different pace compared to the Fed. So, the same, it's half the amount.
Right.
450 basis and 225, it's half the amount. And we haven't even realized that. We thought the Reserve Bank is moving in lockstep.
Right.
So, it's quite possible. Now, what more is left? The expectation is that the Fed will do another 75 basis. If the Reserve Bank pauses or says that we are going into neutral and we will keep our options open on whether a hike is needed, I don't think that will be extremely out of sync. The rupee has strengthened considerably. We were pushing 83, now we are pushing 81. We could straddle 81 sometime soon. So chances are that the Reserve Bank will have the nerve to pause. Okay, we have Aditi Nayar of ICRA with us. Aditi, according to Ekta's poll, the expectation was that the WPI inflation will be over 5%, and it's coming at 4.9. Your thoughts, do the chances of a pause increase in Feb?
Thanks, Lata. See, we had also pegged about 5.6% is what we had forecast for the WPI for this month. So it's come in significantly lower than expected. And again, it seems to be on account of primary articles. So while the argument of core versus primary may be there, I haven't seen the internals fully for the WPI yet. But as we had spoken last week, even after the CPI data, I thought that the chances of a pause had gone up. So this is something that will reinforce that.
Yeah, you were one of the votes. I was just telling Ekta, Sonal and Mangalam, one of the persons who voted for a pause when I did that poll. But you think that we are now done with 6th quarter?
Yes.
That's the terminal rate. Okay. Now,
yes.
This WPI inflation itself, we have seen a significant fall, as you point out, 5.6. Ekta's poll was also 5.6, so the market thought like you, or you thought like the market. 70 basis points lower than what our poll threw up. Do you think this is a consistent behavior, or are we going to see some backlash? Because we already see global prices kind of rising. Manisha was telling us coal, iron ore, steel, all of them have inched up in expectation that China will demand.
So in fact, Lata, that's one of the reasons why we are not really changing, for example, our FY23 CPI inflation forecast, despite the positive surprise last week. So we're still at 6.6% instead of 6.7%.
Okay. So we could
it may be a trough and then a little bit of a reversion after that. Yeah.
Okay, that possibility exists. All right, Aditi, we will leave it at that. Thank you very much for taking our unscheduled call and giving us the benefit of your advice. So there you are. Expectations is that expectation for a pause will go up. Now, we are not yet seeing it in the 10-year. This is because the 10-year is now reacting. It's at 7.31, the 10-year paper. It should have been a lot. It should be going closer to 7.2, given that we may not have a hike. This is largely because there is a fear that the government borrowing program could be high. And we are only 15 days away from that borrowing number hitting us. So the 10-year, which is a spot rate, it is understandable. It is not yet reflecting the slowness. I think we should pull up the 10-year at this point in time. I understand that we have to be showing the details of the WPI, but the 10-year bond is not falling. If you looked at the overnight index swaps, they've fallen considerably. That's a pure rate aspiration market. And there clearly you're able to see the yields falling by a good 25 basis points since pre-CPI announcement. So yes, we are in for the
But
likelihood
as of now,
a
there's
fall.
no expectation of a huge change in the government borrowing program or the fiscal deficit number when the budget, with this budget. So
Yeah,
there's no
you know,
big
the
negative surprise
expectation
which
is that the
expected.
government has already announced that they will come down to 4.5% fiscal deficit from the 6.4%. Now, that is 200 basis points in 3 years, which means they should deliver a 60 to 70 basis points now. Will they deliver that 5.8%? And how much will they borrow from small savings? Because small savings rates are also rising. So they may impose more on the market. There are all these fears. You know, CD rates have gone up. Banks also are chasing more money because, you know, lending demand has gone up.
It's gone up.
There is enough pressure already from the private sector to borrow. Banks are borrowing from the corporate certificate of deposit market. Companies are borrowing from the CP market. Over and above that, if the government borrows a great deal, that pressure will be there. Until now, people were ready to be excess on their SLR because they were not having too much of corporate demand. But now you want to draw down on your excess SLR to service corporate demand. In that context, will you be able to stomach a, 17.5 lakh crore fiscal deficit and probably a 16 lakh crore coming to the market itself? So, I mean, the market's fears are well founded.
Okay, well, we're taking the 22-month low in terms of the WPI and the CPI 12-month low with both hands. Thanks, Lata, for joining in and taking us through this conversation. So definitely a positive WPI figure which has come through. But the core inflation has still remained sticky. It's down on a month-on-month basis, but it's still at around 3.2% versus around 3.5% in the previous month. But overall, the headline WPI is lower because of a lower food inflation. Take a short break, but on the other side, full tilt back on the markets and stocks which are reacting to news updates. Stay tuned.